Right now, something very important is happening in the global financial system, and almost nobody is talking about it. There is no big crash headline, no emergency press conference, no red-breaking news banner, but behind closed doors, inside banks, inside credit markets, and deep in the plumbing of the financial system, liquidity is quietly freezing again. This is the kind of moment that looks boring on the surface, but later people say, that was the warning sign. If you've ever wondered how financial stress really begins, this is it. Slow, silent, and hidden in plain sight. What makes this moment dangerous is not panic, but calm. Markets are still functioning. Stock prices still move. Earnings calls still sound optimistic. But beneath all of that, the flow of easy money that kept everything alive is tightening. Banks are becoming more cautious. Credit is harder to get. Lending standards are quietly shifting. And history shows us that when credit tightens quietly, problems usually show up loudly later. On macro signal, we don't wait for the crisis to become obvious. We watch the signals that move before the headlines do. And right now, multiple signals are lining up in a way we've seen before, just before stress spreads through the system. Before we go deeper, take 2 seconds to like this video and subscribe to Macro Signal. It tells the algorithm this content matters, and it helps this channel keep bringing you what most people only understand after it's too late. Here's what most people don't realize. Liquidity doesn't disappear overnight. It doesn't vanish with a single event. It drains, slowly, quietly, almost politely. Banks don't announce it. Central banks don't highlight it. But you can see it if you know where to look. Loan growth starts to stall. Credit approvals take longer. Small businesses hear, not right now, instead of approved. Repo markets begin to show subtle stress. None of this trends on social media, until suddenly it does. This is how financial pressure really builds. Not through fear, but through friction. Every small delay, every tighter condition, every extra requirement makes money move slower. And when money moves slower in a system built on speed and leverage, something eventually breaks. What's especially important right now is the timing. After years of aggressive rate hikes, banks are sitting on balance sheets that look stable on paper but fragile underneath. Long duration assets, unrealized losses, higher funding costs. At the same time, borrowers are facing higher interest expenses. This combination forces banks into survival mode. And survival mode always means one thing: protect capital first, lend second. You won't hear bankers say, "We are tightening credit because we're worried." Instead, you'll hear phrases like selective lending, risk management, or changing market conditions. But the outcome is the same: less liquidity flowing into the real economy. And here's the part that keeps repeating throughout history. When credit tightens, it doesn't hit everyone equally. Large institutions feel it last. Small businesses feel it first. Consumers feel it quietly. And by the time markets react, the damage has already been done. This is why paying attention now matters. Not when panic arrives, but when signals whisper. Stay with me, because next we're going to connect these quiet credit shifts to the repo market, banking stress, and why this phase often lasts longer than people expect, and why most investors completely underestimate it. To understand why this matters so much, we need to talk about how banks really behave when pressure builds. Banks don't panic the way markets do. They don't sell everything in one day. They quietly pull back, they slow lending, they reduce exposure. They become very careful about who gets money and who doesn't, and this is exactly what we're seeing again. Recent lending data shows a clear shift. Commercial loans are growing slower. Some categories are flat, others are quietly contracting. This isn't because demand suddenly disappeared. It's because banks are choosing caution over expansion. When funding costs rise and balance sheets feel stressed, lending becomes a risk, not an opportunity. And then there's the repo market. This is one of the most important but least understood parts of the financial system. The repo market is where institutions borrow short-term cash using high-quality collateral. When liquidity is healthy, repo rates stay calm and predictable. When stress builds, small disruptions start to appear. Rates spike briefly. Access becomes uneven. Nothing dramatic, just enough friction to tell you something underneath is changing. This is how hidden stress looks. It doesn't scream, it whispers. Central banks know this, which is why their language has changed. Notice how policy statements now emphasize monitoring conditions, data dependence, and financial stability. These are not confident words. They are careful words. They signal awareness that tightening has consequences, and those consequences don't show up instantly. Meanwhile, companies are feeling it too. On earnings calls, executives are being optimistic on the surface, but listen closely and you hear the shift. Oh, we're focusing on efficiency. We're reducing leverage. We're being disciplined with capital. These phrases all point to the same reality. Money is no longer cheap, and access is no longer guaranteed. On macro signal, this is where we pay attention, because liquidity is the oxygen of the financial system. When oxygen levels drop slowly, nobody notices until performance declines. Growth slows, defaults rise quietly, and then suddenly something triggers a larger reaction. This is why the current phase is so dangerous. It feels manageable. It feels controlled. But systems built on leverage don't break in a straight line. They bend first, they stretch, and then they snap. What's also important is how long this phase can last. Liquidity tightening is not a one-week event. It can run quietly for months, sometimes over a year. And during that time, markets can still rally. Headlines can still sound positive. That's what confuses people. They assume if prices are up, stress must be gone. But liquidity stress doesn't care about short-term price moves. It shows up later, when refinancing becomes harder, when rollover risk increases, when one weak link exposes the pressure everyone else was hiding. And when that happens, the same people who ignored the early signals start asking how nobody saw it coming. We're going to go deeper into why this cycle looks familiar, what usually breaks first, and why retail investors are almost always positioned wrong when liquidity quietly freezes like this. Stay with me. One of the biggest mistakes people make during phases like this is assuming that stress always starts in the stock market. In reality, the stock market is usually the last place to react. The real pressure builds in credit markets first. That's where confidence quietly disappears. That's where lenders start asking tougher questions. And that's where liquidity slowly stops moving the way it used to. Think about how the system actually works. Most businesses don't survive on profits alone. They survive on access to credit. They refinance debt. They roll over loans. They depend on predictable cash flow. When banks pull back, even slightly, the entire chain starts to weaken. Projects get delayed. Hiring slows. Expansion plans quietly disappear. None of this makes headlines, but it changes the direction of the economy. This is why tightening credit is more powerful than rate hikes themselves. Rates are visible. Credit conditions are not. When banks raise standards, it doesn't matter if rates stay the same. Money becomes harder to access, and harder access always leads to lower activity. Another hidden signal showing up right now is duration risk. Banks and institutions are still holding assets bought when yields were much lower. On paper, these assets look fine. In reality, their market value is stressed. As long as those assets don't have to be sold, the problem stays hidden. But once liquidity tightens enough, forced decisions begin. And forced decisions are where cracks turn into breaks. This is where history becomes very clear. In past cycles, the early signs looked almost identical. Credit slowed, liquidity tightened. Officials reassured everyone that the system was sound, and for a while they were right, until they weren't. What usually breaks first isn't the biggest institution, it's the weakest one, the one with bad timing, the one that depended on easy refinancing. And when that happens, confidence drops instantly, not because of the size of the failure, but because of what it reveals. On macro signal, this is the phase we track most closely, not because it's dramatic, but because it's predictive. When liquidity freezes quietly, the system becomes fragile. And fragile systems react badly to surprises. This is also why volatility can stay low right before stress explodes. People confuse calm with safety, but calm often means risk is being mispriced. When everyone assumes stability, protection disappears. And when protection disappears, small shocks cause outsized reactions. Another important point is timing expectations. Many viewers ask, when will it happen? That's the wrong question. Liquidity stress doesn't work on a schedule. It builds pressure until something gives. Trying to predict the exact moment misses the bigger picture. The smarter move is understanding the direction. And right now, the direction is clear. Banks are defensive, credit is tighter, liquidity is slower. That combination has never ended smoothly. We're now entering the part of the cycle where patience gets tested, where people who ignored risk start chasing returns, and where disciplined observers quietly prepare. In the next part, we'll connect this liquidity freeze to consumers, real economic data, and why the final impact often shows up where people least expect it. As liquidity tightens at the banking level, the effects don't stay there. They move outward, quietly, into the real economy. This is where things start to feel different for ordinary people, even if they can't explain why. Payments feel tighter. Credit card limits stop increasing. Loan approvals take longer. Monthly expenses feel heavier. None of this sounds dramatic, but together it changes behavior. Consumers don't suddenly panic. They adjust. They delay purchases. They avoid large commitments. They keep more cash on hand. And when millions of people do this at the same time, economic momentum slows, not because of fear, but because of caution. This is why official data often lags reality. By the time numbers confirm a slowdown, the slowdown has already been happening for months. Liquidity stress always moves faster than statistics, and markets, once again, tend to notice late. Another area where pressure quietly builds is commercial real estate and small business financing. These sectors rely heavily on rolling credit and predictable funding. When banks tighten standards, refinancing becomes harder. Valuations adjust downward. Projects stall, and stress accumulates where visibility is lowest. What's dangerous is how disconnected perception can become from reality during this phase. Headlines might still focus on growth, innovation, or optimism. Markets might even rally on hope of policy relief. But liquidity doesn't respond to hope. It responds to balance sheets, risk tolerance, and funding costs. This creates a strange environment where warnings are dismissed because nothing has broken yet. But the absence of collapse is not proof of safety. It's often proof that pressure is being absorbed, for now. On Macro Signal, we pay attention to these quiet transitions, because this is the stage where positioning matters more than prediction. You don't need to know the exact trigger. You need to know the conditions, and the conditions right now are tightening, slower credit, defensive banking behavior, rising refinancing risk. These forces don't reverse quickly. Even if policy shifts, the psychological damage inside the system takes time to heal. This is also where narratives begin to change. Instead of growth stories, we hear resilience stories. Instead of expansion, we hear efficiency. Instead of risk-taking, we hear caution. Language always shifts before behavior becomes obvious. We are now close to the point where liquidity stress moves from invisible to undeniable. Not everywhere at once, not in a dramatic collapse, but in specific pockets that reveal the broader truth. In the final part, we'll bring everything together, why this cycle keeps repeating, what usually catches people off guard, and how paying attention early can change outcomes. When you zoom out and look at the full picture, a clear pattern appears. Liquidity doesn't vanish suddenly. It tightens quietly. Credit slows before markets react. Stress builds where nobody is watching. And by the time headlines catch up, positioning has already been decided. This is why cycles like this feel confusing. People expect a single moment, a clear signal, a dramatic event. But the real shift happens earlier, in silence. Banks become defensive. Lending becomes selective. Refinancing becomes harder. And the system becomes fragile long before it looks broken. Every major financial disruption of the past followed this path. The names change, the reasons change, but the mechanics stay the same. Liquidity is the foundation. When it weakens, everything built on top of it becomes unstable. Right now, we're in that uncomfortable middle phase. Nothing has collapsed, but the conditions are set. This is the stage where overconfidence quietly returns, and caution feels unnecessary. And historically, this is when risk is highest. On Macro Signal, the goal is not fear, it's awareness. Understanding how the system actually behaves gives you an edge most people never have. You stop reacting to noise and start paying attention to structure. And structure is what determines outcomes. As this liquidity freeze continues, the biggest mistake is assuming normality will protect you. Systems under pressure don't reward complacency. They reward patience, discipline, and the ability to see beyond surface-level calm. If you've watched this far, you already understand something many don't. And I'd really like to hear your perspective. Do you think this tightening ends quietly, or do you think it breaks somewhere unexpected? Drop your thoughts in the comments. I read them all, and your insights help shape future Macro Signal videos. And if you found this breakdown useful, share this video with someone who still thinks everything is fine, just because markets look calm. These are the conversations that matter before the headlines change. We'll keep tracking the signals others ignore, because by the time everyone sees the problem, it's already too late.